And now I would like to, call upon our next panel. So the next Fireside Chat is on the topic of Indian economy and impact on real estate, which will be moderated by Mr. Santhosh Kumar, a Vice Chairman of ANAROCK Group. With over 20 years of experience, Mr. Santhosh is highly respected in the real estate industry and successfully manages and executes operational excellence across India and the GCC market. Mr. Kumar will be in conversation with Mr. Saugata Bhattacharya, who is the Executive Vice President and Chief Economist of Axis Bank. Dr. Bhattacharya is a respected financial expert with more than 15 years of experience, often quoted on a variety of monetary policy and financial market issues. At Axis Bank, he is responsible for providing decision-making support to the business units, macroeconomic views to institutional and individual clients, and segmented analysis of banking trends for the retail business. Dr. Bhattacharya was a member of RBI's Group on Monetary Policy Operating Procedure for 2010 and the Finance Ministry Group on Estimating Foreign Savings for 2011. Before that, in 2007, he was part of the core group which drafted the Percy Mistry Committee report on making Mumbai an international financial center. Over to you, Mr. Santhosh Kumar, for this fireside chat with Dr. Saugata Bhattacharya.
Thank you, Pushkar, and good evening, everyone, and also welcome, Dr. Saugata. It's been my honor and pleasure to welcome you for this session. And I know this session has been going on since this afternoon, and I don't think it's better time than having this session when we just had the budget and the gathering here wanted to understand the economy and more realistically on the real estate side. The budget, the recent budget, which is, most of the people claim as a growth-oriented booster budget. And we saw that a lot of emphasis on infrastructure, digitalization, and more on Atmanirbhar. And there has also been a massive push on capital spending. I think this is going to boost or create opportunities for the real estate sector, which I may rightly say, by creating employment and also providing much needed infrastructure, which will definitely facilitate or benefit the real estate sector. And as everyone knows, real estate sector contributes hugely on the nation's economy. And, as per the estimate, it contributes around 6% of the nation's GDP. And this is going to be by the year 2025, there is an estimation that it might go up to around 13 to 15%. And it's also the second largest employment generator, and also provides support to the supports more than 250 ancillary industries as well. So to discuss this topic more, to understand the economy more, the real estate, we have got eminent economist Saugata is here, and it's my privilege to have him here to discuss the various topics which we have. Dr. Saugata, my initial thoughts are, if you can provide your initial comments on some of the three recent, phenomenon or recent factors, primarily on the budget, second on the, Ukraine-Russia fiasco, and the third one on the Fed rate, which is, proposed to be increased, Saugata. Especially on the budget, do you think that, it has got all the ingredients to sustain the 9% growth which has been envisaged for this financial year?
So, thank you, Santhosh Saab. Thank you, CII, for this wonderful privilege and opportunity of interacting with all of you. I'm very nervous. We are this topic is real estate. You are the experts. I'm the economist. But as you mentioned, Santhosh Saab, that talk about the Fed, talk about Ukraine, talk about the budget. So this is the good thing about being an economist. I mean, even if the knowledge is limited, you can afford to talk about multiple things. So, but generally, but thank you very much. So let's start from the foreign side. So I mean, rather than India is going to face a fairly significant headwinds from the external side. Let's start with Ukraine. Because this is something which is going to impact a lot of economic variables as well. You've already seen with the crisis coming in, the price of crude oil has gone to 95 or so. I mean, come down a little bit, but it's gone up there. Prices of natural gas have quadrupled since last year. There are other features. All the logistics problems, etc., is going to be another major issue. The bottlenecks that were slowly beginning to open up. Now, why? I mean, this is a very this is like the game of chicken. So who's going to blink first? We've heard yesterday. I mean, markets in economists and finance market conditions, they talk about risk on, risk off, where equity markets go up, equity markets come down, etc. So there was talk of some Russian pullout from Ukraine, from the south, from the Crimea region, from the exercises, which has now been vehemently denied by the US and the NATO countries. So this is a complete game of information, misinformation, disinformation coming in. Nobody really knows. Nobody really knows what Mr. Putin is looking to extract from the West. My own sense is, maybe even as we speak, maybe something is going to happen. My own sense is he's not he's too much of a he's not a fool. So he knows exactly what is the threshold to which can go before and not go further. So my sense is it's not going to develop into a full-blown war, but he definitely wants to destabilize the Ukrainian government and put in his own person in the country, and then try to get as many concessions out of NATO and the US as possible. He knows that he's not going to get NATO to go out of the ex-Soviet countries, but he's already succeeded in his main objective, that Russia is now recognized as a superpower, back again as a superpower. So that he has achieved that objective. So many of the objectives, he's divided Europe, managed to divide Germany on the one side, many of the other countries on the other. So many of his objectives have already been met. So if you can get some small, my sense is there's not going to be a full invasion. Coming back now to the actual economic environment. So you're probably going to get some oil prices coming down a little bit. You have already seen that $90 per barrel, etc. But it's going to be elevated because the oil, I'll come back to the oil market a little bit. From the Fed side, the Fed has been and this has been a very remarkable pivot from the Feds. The central bankers typically don't do that. They don't want surprises. They typically telegraph their intentions well in advance, to get the markets to prepare. But what the Fed did within the last 3 months or so was an absolutely remarkable pivot from going into, no, inflation is transitory, inflation will not, it will come down very, very, very quickly within the space of 2-3 months. They have gone into an incredibly hawkish stance, and this has really pushed up interest rates, etc. in the system. Obviously, this will have a spillover effect into all emerging markets, including India. So that's a story that will come down later. On the Fed, and this is not just the Fed, the Bank of England, the Bank of Canada, they're all adopting fairly hawkish positions. All the G10, the major central banks of the world, are adopting the hawkish positions. My sense is, even in this, the markets are already pricing that the Fed is being too aggressive in signaling steady rate hikes throughout the course of 2022, which they will not be able to do. There will be a very quick slowdown in the US, and they will have to slow down or stop the interest rate hike. So keep that in mind as we go. What will be the impact on India? Now, this is where the Reserve Bank story comes in. You've just seen the Monetary Policy Committee report. You've heard Governor Das saying that they will be influenced more by domestic considerations, not so much by the Fed or what the other central bankers do. Our moats are very strong. We are well fortified. I mean, we have 630 billion of forex reserves. Our economic fundamentals are quite strong, and therefore we will act according to our own individual concessions. This is where the budget comes in. So the question is, how fast is the economic recovery that we are seeing now? I'm sorry, I'm taking a little bit time on this, another 30 seconds. How quick is the economic recovery? The budget actually has a fairly moderate, very conservative projection for the growth that it's taken. For the budget, it's the nominal GDP growth, the real growth plus inflation, which is important, because that's what brings in tax revenues. They have taken about 11% growth, which is, to my mind, a low-balling of growth rate. But this is now being echoed by even the Reserve Bank, which says that the real growth rate is likely to be 7.8%, which is in line with with what the government is also assuming. But this will be overshot. I mean, the actual growth rate is likely to be about 13 to 14%. Now, the question on the budget is the sheer pivot onto the capital expenditure, as you mentioned. So that's a very good sign. But there is also a subtext to this that it's some part of the capital expenditure is due to previously they used to put a lot of the responsibility on capex to many of these agencies like NHAI, like FCI, other ministries, railway ministries, other roads ministries, etc., to borrow from outside. Now they have brought all of this into their own budget, but it's still very heavy. Ultimately, whatever happens, the question is growth. If we can grow, forget about next year, whether we grow at 8% or 8.5% or whatever, can we grow at a sustained 7%, 7.5% over the next 5 or 6 years? And that's the way that we are going to get demand. That's the way that we are going to get demand for housing, demand for a whole range of commodities and all the associated, the enveloping industries that you were talking about to the real estate. That is the critical question, and that is a matter of implementation. The states, mind you, we don't talk about states too much, but the focus needs not just the center, probably even more than the center, what the state governments are doing in terms of their capex programs, their reforms, etc., is going to be critical to ensuring that we can grow sustainably without the economy heating up, without having to raise interest rates, etc., over the next 5 years, 10 years. So that's going to be the critical part. And as in everything, implementation, both of the center's capex programs and the state's capex programs will be the key to going forward. I'm so sorry. My apologies for this long.
No. I think you beautifully explained, Doctor. I completely agree with you that if you can sustain this growth, I think this is going to be very, very important, and the growth story will continue, and it's going to benefit the real estate sector as well, Doctor. And we are quite confident. Those who are hearing, they must be thrilled to hear what you said. If you can able to sustain this growth for the next 4 to 5 years, and that will definitely give boost to the real estate industry, and we'll be also able to sustain the similar growth in this industry as well. Coming to your question on recovery, Doctor, do you think that the economy has fully recovered from the pandemic, or do you think there are still some underlying fault lines?
No. So we have not fully recovered. No. So some parts of the economy has recovered. I'll put one statistic in front of you. Our economy before the start in March 20, before the pandemic, was about 200 odd lakh crore rupees, 200 trillion rupees. At the end of this year, at the end of March, we are likely to be about 230 trillion. So 230 lakh crores. Over 2 years, that's a jump of 30 lakh crores. So in the next year, FY23, it's likely to be another 30 lakh, 260 lakh crores. So how this 30 lakhs over the last 2 years and how another 30 lakhs going forward into the next year is going to be distributed is going to be very critical to our story of how much can you sustain demand, what will be the role of the budget in other than creating capacity through capex, etc. What will be the role of the budget in redistribution? What will be the role? How will the middle class benefit out of this growth? And particularly, the thing that needs to be mentioned is the role of the MSMEs, the micro, particularly the micro and the small businesses, because it is this which is the consuming class, not just the mid-level, micro and the small businesses segments within the MSME, which will be the consuming class, and that will sustain demand. But for our, I mean, for the real estate segment, for the mall segment, for the commercial real estate segment, what is important are the top deciles, the top 10% or the top 20%, or maybe the top quintile, the top 25%. How they recover from this, how, because that's the segment that will generate the bulk of real estate demand, residential real estate, other types of real estate in the segment. You are hearing about data centers, you are hearing about logistics, other real commercial real estate segments. It is that segment that is likely to be the driver for growth. The capex and the capex is designed to boost that segment, whether it's the actual monies that are being put out, the PLI schemes for manufacturing, the focus on digitization, etc. That will be important. So, but overall, there are still very deep economic scars. A large segment of the MSMEs have lost their livelihoods. But remember, people talk about consumption versus investment. Should the budget not have given more focus to consumption? Remember that capex, when the government spends, it actually comes down. I mean, you know, the large project developers have their contractors, the subcontractors, and all the way down to the small guys who build the nuts and bolts for the construction of the large projects. So income does come down into the hands, into the pockets of even the MSME segment. So overall, I mean, the budget focus is good, as we talked about first. I mean, it does focus on the medium term over the next 3, 4, 5 years. To try to build up capacity in the system while making, I mean, there's room for debate. Should we have cut customs duties more? Should the PLIs have been designed differently? But the focus is definitely on creating manufacturing growth. And plus, I mean, we have already, one of the key structural changes that has happened is now the pervasiveness of technology. We were hearing in the shopping mall with the speakers there. Everywhere down to the tier 1, tier 2, tier 3, and even smaller cities. I mean, you know, I mean, technology has pervaded there, and that is helping to build India's competitive. We have leapfrogged into the technology domain, and it's going to increase India's competitiveness, which is a very good sign for our future growth.
I agree with you, Doctor. You know, it's again very critical for the implementation of these, you know, a big announcement of the infrastructure. You know, ultimately, these infrastructure, you know, programs are going to create, you know, employment generation, and ultimately, it's going to increase the income in the hands of the, you know, skilled or the non-skilled laborers, which ultimately going to help the economy through a consumption. Next question from my side, you know, again, Doctor, you know, in the budget, we did not see many, you know, announcement for the real estate industry. Industry was expecting huge announcement, but government has proposed a bigger allocations for the affordable industry. But how do you see the, you know, the real estate industry heading over the next 5 to 10 years ahead? You know, how do you say, you know, if you look at residential real estate, had a very bad last 10 years. You would have seen there was not much of a demand, you know, developers getting into all sort of trouble. And post-pandemic, you know, fortunately, market bounced back, and there is a huge demand for the residential real estate. How do you see the next 5 to 10 years, Doctor?
So, I mean, great question. The first thing is the troubles that you referred to, particularly in the past 5 years or so, what one of my the chief economic advisors of the government described as a twin balance sheet problem. So it was actually, I mean, you know, so a lot of borrowers, commercial borrowers, real estate borrowers, other borrowers, infrastructure sponsors, etc., had over leverage, and it was not entirely their fault, because I mean they were borrowed based on some cash flow assumptions, etc., which did not pan out. I mean, you know, many of the infrastructure projects, many of the real estate projects ran into trouble. The interest rates went up through the roof, and together with this, the balance sheets of banks, NBFCs also took a major hit. You would have seen in 2018 the NBFC fiascos. banks were stressed with very high NPA ratios, etc. All of that now, to a very large extent, has been resolved. Corporates have deleveraged with this huge liquidity infusion by Governor Das and the RBI over the last 2 years. That has helped. And even before this process had started with the IBC, many of the bad loans of the banking sector are slowly getting resolved. So banks are much better capitalized, etc. So from a lending perspective, both the lending and the borrowing perspective, with healthy balance sheets of both borrowers and lenders, if the opportunities come about, both are ready to start with a new set of projects. The new CapEx cycle is now ready to start. Of course, I mean, there are a lot of issues on demand, capacity utilization, etc. And the same thing with real estate. The thing that you're saying, that, I mean, the budget is still focused to a certain extent on the affordable housing. I mean, that's the target segment. And the government has announced that's the key focus, both through the Prime Minister's Awas Yojana, the affordable housing segments, the incentives for the affordable housing. That's the key focus. Nobody really knows why. I mean, more people the real estate industry definitely was expecting more incentives. It's anybody's guess. My own guess is the thinking of the government is that with too many incentives going in, there's a general reluctance to come back to that old phase where there was a massive increase in real estate prices. It was almost like a speculative thing. I mean, the thinking seems to be that we want to avoid that kind of speculative rise in another. I mean, you're seeing this in equity markets, you're seeing this in cryptocurrencies. We don't want this coming in back into the real estate, residential real estate segment. Remember, we talked about the 30 lakh crores worth of additional income that's been generated over the last 2 years. Their worry is this: if we do more incentives for, I mean, whether I mean, you know, second housing or whatever that they had taken out, it's going again into the hands of a very small set of potential households, the higher income households, and this will take prices up and squeeze the middle segment. The affordable segment is one, the mid segment gets squeezed. So that's my sense that's one of the reasons that's on their mind, that they don't want to give too many incentives. Their own data analytics, etc., will have told them that take the 1 lakh, 1.5 lakhs exemptions up. So it's again concentrated. You know, anyway, I mean, it's only about 4 crore taxpayers they're in the system. So these guys can afford to buy it, even if they keep the 1.5 lakh crores. So these multiple things, I think that's the core focus of the segment, that we don't want that kind of speculative bubble to arise again. And if we and finally, of course, I mean, you know, they do need the tax revenue. So I mean, they can't afford to give exemptions. Whether, I mean, even the salaried classes like me were looking for further exemptions. They feel that, I mean, you guys have done enough for yourself. I mean, time for you to try to give the government some additional resources so that we can start that redistribution program that the economic scarring has created from the pandemic. That's the broad sense that I'm getting from the government.
But again, Doctor, you know, in order to control the prices, I think this is a vicious cycle. You know, post the pandemic, in many of the markets, the unsold inventories are getting reduced, and the industry body is looking at announcement coming from the finance minister, you know, announcing this real estate sector as a infrastructure structure, or as a to provide a industry status to this sector, because, you know, capital is the need for the many of the developers today to come out with the new launches, because many of the developers do not have the capital to, you know, either to acquire the land parcels or getting into a larger project. So the capital is a need for all these developers. Yes, the market is also getting consolidated. Many of the good players are really coming out with the new launches. But if you look at the overall industry, I think what is they are looking was basically to give them with capital support, which is very, very important to you know, do new development, new launches, so that prices remain stable and stagnant.
No, so again, I mean, there are pros and cons to the argument, and I'm trying to get into the government mind. I mean, you know, I don't have access to what their thinking is in terms of giving industry status to the real estate segment.
Yeah.
You're very right. This has been, as Mr. Puri also keeps on saying, that there's been a significant consolidation, massive consolidation in the real estate players.
Yeah.
Now, this is where the RBI and the government's focus begins to come in. That their view is probably that, look, interest rates are already very low. This is where the RBI governor in the last policy came out with, that I'm not going to raise interest rates. I mean, I want interest rates to remain low. So given the fact that the balance sheets of real estate promoters, real estate developers, sponsors is much healthier, banks have access to, banks are capitalized, they have access to funds, low cost funds, which they want to deploy. NBFCs, banks, which they want to deploy. I mean, you're already seeing home loans increase, home mortgages increase. Banks want to deploy it in good real estate projects. So their sense seems to be that, look, interest rates are already low. Even if if we give you an industry status or whatever, it might on the margins make some difference. I mean, a few basis points of loans coming in. But if I can stick to an environment where inflation remains more or less moderate, interest rates remain more or less moderate, your access to funds, low cost funds, low interest rate, is already there. So probably at this point in time, rather than change with, and remember again, from various, again from the buyer side, they're trying to shift the whole tax structure away from exemptions into one basic low rate into. So giving any type of exemptions or industry status here, industry status there, I think that they feel that is likely to distort this structure. So we'll stick to low interest rates. We'll make sure you have access to credit, and let's see how things go before we take the next step of looking at this as an industry.
I do hope that the interest rates remains low, Doctor. And again, many of the developers are now looking to, come into the markets. They wanted to list their companies. Do you think that it is prudent for the developers to get listed, or would it be better to remain private?
I don't really. I mean, you're seeing the spate of IPOs in various segments. So, I mean, in various sectors. So, obviously, I mean, there is a vast amount of domestic and global capital that is available. So, this is a very specific developer to developer story. So, there are advantages to remaining unlisted. I mean, but at the same time, many of the private equity investors in some of the major property developers, real estate developers, they might be looking to exit. They might be looking for an exit route, which is where an IPO helps. So I think generally, I mean, there are, it's a very specific question. I mean, so this depends on the balance sheet. This depends on the need to access equity capital, etc. So and the covenants that are there in the credit, in the loans, etc. that are given. So, I mean, overall, but there's an opportunity. If somebody does want to list with a good balance sheet, I think the opportunities to get in a new set of investors at this point are very high.
Okay, it's a good news because there is a mixed reaction from various experts, but I leave it there only, Doctor. Again, post-pandemic, Doctor, there was a reverse migration. Many of the people who were in the urban locations, they have moved into their rural areas, and which has really increased the demand for residential in tier 2 and 3 cities. Do you see that that phenomena will continue to be there in the tier 2, tier 3 cities? Because why I'm saying that, I've been in Chandigarh, which is again considered as a tier 2 cities. People were telling that it never clicked for the IT segment. But the post segment, many of the IT companies have come and set up their operations in those cities because people do not want to move into larger cities now. They wanted to run their operations from where they have their house. So do you see that the story of tier 2, 3 cities is going to work in the near future?
Santhosh Saab, you have already articulated this so well. Absolutely. I mean, even from our own bank lending, etc., what we hear from various sources, that there is a very strong, and it's not just from the tier two. I mean, there's now a clear preference. And this is a phenomenon across sectors. I mean, whether in automobiles, in FMCG, in real estate, there's a preference towards premiumization. So, I mean, people want larger houses. They know that work from home, hybrid work practices are here to stay. So double income families, and this is what is remarkable. I mean, we have run out of time. I'll just take 30 seconds. So at the one side, there is a huge problem of employment that we all know. I mean, I don't want to give numbers. On the other side, there is a massive demand for skilled professionals, and there is a shortage of talent. So as a consequence of this, the income salaries of that small segment has absolutely shot up. And this has given a huge amount of spending power. Now, in the absence, I mean, so one part is the work from home. I mean, the dual income families, they need larger homes from which to operate, one room for an office, etc., all of that. So there's this clear thing that is being seen. IT companies are moving down into the tier 2, tier 3 cities where they're picking up talent from those cities and asking them to stay. And they're happy to stay there because, I mean, they can get with the same salaries, I mean, the tier 2 cities, that the salaries that are paid in Mumbai and Bangalore and Chennai are more or less getting paid in those cities. And so that's pushing up that premiumization. Plus, in addition to this, another part, the huge expansion in metros and other, I mean, the connectivity, roads are getting better. That is also pushing people away from city centers into the peri-urban areas. So within the tier 1 cities, I mean, people are getting into the outskirts of the city. These trends will only continue over a period of time.
Okay, my final question, I know we are running out of time. My final question to you, everything looks good. The post-pandemic, market has really bounced back in a very fast manner. If I may ask you, from a real estate side, what do you think which can go wrong from here onwards, which can impact the customer confidence or the demand generation, and what are some of the pitfalls we should be aware of?
So one part is, I don't see too many. I mean, I think if nothing goes dramatically wrong from the political side, I think there are structurally so many things that have changed: the financialization, the consolidation, the formalization, etc., which is pushing up competitiveness, all the government support for PLI schemes, exports, etc. One key risk in the immediate future is the rise in interest rates. So as we just started this discussion, that the Federal Reserve, the other central banks push up rates sufficiently enough and are able to do that very quickly, this will obviously have an impact on the country. So, I mean, the first thing is that the rupee will start depreciating faster because the divergence between the RBI stance and the global central bank stance. And if that happens, inflation will begin to push up. And then on top of that, if recovery pushes up, other than the oil prices, the steel prices, the aluminum prices, nickel prices, etc., this increasing demand recovery within the system will also lead to companies passing on higher input costs to the end consumer. So inflation begins to go up very significantly, which will push the Reserve Bank to raise interest rates even further. So that's the immediate risk. Other long-term structural changes, I think, are very beneficial to the system, but that other factor still remains the thing that we talked about midway, that if this income inequality and even more the wealth inequality becomes too much, this will create social fissures, social chasms in the society, which is never a good thing for society. That's something which all policymakers will need to be very aware of, but to sustain, to end this discussion, to sustain the goal towards the 5 trillion economy, 10 trillion economy very quickly. The social compact, the contract between society, that should remain, that fabric should remain very, very important.
Thank you, Dr. Saugata. Thank you so much for your, sharing your thoughts on various aspects on the economy as well as on the real estate sector. As you rightly said, I think real estate is going to contribute a lot in our journey of achieving the $5 trillion economy. Thank you so much.
Thank you so much, sir.
Over to you, Pushkar.
Thank you, sir.
Thank you. Thank you, Mr. Kumar, and thank you, Dr. Saugata Bhattacharya, for that excellent session, fireside chat, which was very, very enlightening for all our listeners and the audience at large. So we had an excellent inaugural session in the presence of Mr. Tyagarajan today, Chairman CII Western Region, Mr. Deepak Parekh, Chairman HDFC, and Mr. Rakesh Jhunjhunwala also joined in for the session. Mr. Tyagarajan stressed on the optimism in the industry and hoped that with strong fundamentals and support from the government, we can be confident that the real estate and housing sector will lead the revival of India's growth story during the decade ahead. Mr. Anuj Puri set the context of the Confluence by sharing encouraging numbers of the Indian real estate market that will touch $1 trillion by 2030 if GDP contribution of the sector moves from 6% to about 13% by 2030. Mr. Deepak Parekh, Chairman of GFC, congratulated the real estate sector for demonstrating remarkable resilience because segments of real estate sector were reeling from NBFC-driven liquidity crisis during the start of the pandemic. And Mr. Jhunjhunwala gave us the mantra for growth, which is process and has many ingredients: reputation, timely delivery, good quality with will compensate with better prices over time. Followed by which we had very informative panel discussion that deliberated on how new and the next of residential real estate, and an interesting session on shopping experiences getting reimagined with leveraging the phygital experience. And of course, a fireside chat with Dr. Saugata Bhattacharya, Chief Economist of the Axis Bank. So, ladies and gentlemen, thank you very much for joining us today for today's session. And we definitely look ahead to see you tomorrow again for a very power-packed, equally power-packed session. And we would also like to thank our partners, our sponsors today, Signature Global, for supporting the session, and of course, our knowledge partner, ANAROCK, for leading the session. Thank you very much.